Hello everyone, and welcome to this market correction and pilot positioning video. It has been again another tough month for Nifty 50, and you most likely would have seen your swings and positional trade not working out in your favor as well. But if you just focus at the commentary that I had given in the previous month at this particular point, we had discussed that Nifty 50 has been in a well-established lower high, lower low market where we can clearly see a lower low, another lower low being created, and lower highs have also been made in the process. And the thing about trends is whenever there is a higher high, higher low trend in play, or a lower high and a lower low trend in play, you will clearly see that that trend is not going to reverse very quickly. It's not going to happen that the market is going to go up and straight away keep heading in the higher direction. What we would rather see is first the market would be going up, then it would be coming down. In the process, it would be making a higher low, and then we would see the market make another higher high. This is the market where we have to be aggressive. This is the market where we have to be defensive. When we are knowing that a well-established downtrend is there in play, we should not be taking the risk of going aggressive in the market. And this is where the concept of pilot position comes into play. And I've often told you that we are not effectively in the market of making money. We are rather in the market of protecting money. And in money protection, what we usually see is there are two aspects. One is the management of stop loss, and then there is the aspect of position sizing. Now, stop loss management, usually most people would be telling you that you should be taking your stop loss. And if you don't take your stop loss, there is a tendency that the market is going to wipe you out of this place. The other aspect is position sizing that most people don't speak. In terms of stop loss, I have already given you the aspect of 5%, 8%, 10%. With every 5% fall from your point of entry, you can consider offloading 1/3. In 8%, you can consider offloading another 1/3. And at 10%, you should be out of all the positions that is there in the market. So that is when it comes to risk management, 5%, 8%, 10% rule. But in terms of position sizing, this is an aspect that most people do not discuss. However, if you are to be here in the market for the long term, if you are to analyze and assess the market in the best way possible, you cannot just ignore the aspect of position sizing. And this is where in the previous month, you should have been having a defensive position sizing simply because the Nifty 50 was clearly telling you that we are currently in a lower high and a lower low market. But let me just take this concept of pilot position sizing and let me see if I can remove the screen. Yes, there is sufficient space over here where I can write as well. So here, let us take into consideration that you have a 5 lakh portfolio. Now, when you are to go defensive and aggressive in the market, what outcomes you may be potentially having, let us just discuss that. Whenever you're going to have a defensive outlook in the market, you are going to create pilot positions. In this pilot positions, what I usually prefer is I take 1/3 of the capital that I have. Let us consider that you have a 5 lakh portfolio value, and in defensive position sizing, I would be taking 1.5 lakh only for creating the positions. Now, I would be dividing this 1.5 lakh into 3 stocks as well. I will not be putting that in one stock totally because that would be too much of concentration. A little amount of diversification is also needed. Usually I follow for 10 lakhs, I usually diversify that money into 4 to 5 stocks. And for 3 lakhs or for 4 lakhs or 5 lakhs, I will be dividing that into 3 stocks. So let us take into consideration stock A, stock B, and stock C. Each stock I will be deploying 50K. B also I will be deploying 50K, and C also I would be deploying 50K. Now in this position where we are seeing the market is correcting, suppose stock A went down 10%, stock B went down 10% as well, and stock C on the other hand didn't go up or go down as well. So here we can say it's at cost to cost. It's at exactly the same point where we had created the position. Now in this, how much we have lost? We have lost 10% of 50K, that is 5K. We have lost in stock B another 10%, 5K. And in stock C, we have not lost at all. So in the process, we have just lost 10K. So 10K on a 5 lakh portfolio is 2% only. Now let us take into consideration if you had the 5 lakh and if you had gone aggressive in the previous month. If suppose I would be having 3 stocks again, A, B, C. In one stock, of course, you would be having a little bit more bias. You would be having a little bit more confidence in the price action reading, and you would be going a little aggressive. So let us say you took a 2 lakh position in this. In stock B, you took 1.5 lakh, and in stock C, you took 1.5 lakh. So in this 2 lakh, you lost again 10%. That is 20K. In stock B, you again lost 15k, 10%, and in stock C, you didn't lose anything. So total is coming to 35,000. So now, effectively, when you were just doing the pilot positioning and the defensive position sizing, you had lost 2%. And when you are doing aggressive position sizing, you have lost close to 7%. Now, this 35,000 may not be looking like a very big amount, and the 10,000 may not also be looking like a very big amount. But if you go for a 50 lakh portfolio, 30 lakh portfolio, as the numbers keep getting bigger, you would be seeing a significant difference with every 1% change as well. And right here, you can see there is a 5% change. So suppose it was a 50 lakh portfolio, that would be close to 3,50,000. So that is again a big amount when it comes to losing. So because the market was not in a higher high, higher low structure, this approach we could not have had. We should have rather had this approach. And this is where you did lose less money, comparatively less money. I always tell you, in this market, or whether you want to make a career in the market or not, if you are here, you should rather consider how do I position myself in such a way that I lose less and less from the market. Because the lesser we lose today, tomorrow we would be having better opportunities to capitalize when the market structure would be heading higher and higher and higher. Because in these market structures, the breakouts would be working very well. The VCP breakouts that I usually discuss, those would be working very well. But when there is a lower high, lower low market in play, the VCP breakouts are going to convert to false breakouts. These would be converting to false breakouts, and usually you would be suffering losses of 10%, 20%, 30%, and we have seen many stocks have even crashed 50%. So in this current market where the structure is not quite positive, where stocks have corrected 50%, 60%, it is unwise for us to think that tomorrow directly market is going to go up and keep heading in the higher direction, and it is going to make all-time highs. That is little unrealistic thinking on our part, and especially if we do focus a little bit on price action reading as well, that is not the appropriate approach. Now, I would also like you to focus on some of the indexes. I cannot discuss stock with you because that is against the rules, against the laws. But index, I can definitely discuss that. Now, if we discuss Bank Nifty, you can clearly see that Nifty 50 is in a well-established lower high, lower low market structure. But this is a point where Bank Nifty can potentially take support from. And one more thing that we should be analyzing and keeping in mind is that Nifty 50 has made a lower low, but Bank Nifty, this is the low which was made in the previous month, and currently it has not made a new low. There's a small difference over here. There is a significant thing that we can analyze from here as well. And in terms of relative strength, we can again say that Bank Nifty is performing better than Nifty 50. So any focus that you should be having right now, even though I would say that most of the banking stocks are not in very good structure, but there are some stocks which you can definitely look at. And in terms of Nifty Finance also, there is some high weightage stock which is again shaping up very well. You should be having a look in those stocks as well. But in terms of another index that I would like to discuss with you is the CNX IT index. And this is the index where we had discussed previously that whenever the market would be heading back to this area, this is the point where we would be looking to add some positions in the IT segment as well. But as now you can see, we are having a big bearish wide range candle closing below the range, and that again is not the most positive thing for the IT sector as well. So right now, if the IT space has to recover, what I would like is the market to go up here, then come back, and then again keep heading in the higher direction. This is the market structure. This is the kind of structure that would give confidence to me. And if I am to analyze the IT stocks, they have also fallen a little bit. So I would urge you that take your time. There is no rush. There is no requirement to go aggressive in the market. With the way the IT sector is currently set up, and with the way that Nifty 50 is currently set up, there is a good chance that we can take another 3 to 4 months for the market structure to improve, and then we can consider creating more positions in the market. So right now, be defensive. There is no requirement to rush through the process. And this is a fantastic opportunity for you to learn. Usually people say that in the bearish market, the best of learnings happen. And in the bullish market, usually the confidence is built. So do the homework in the bearish market, take the lessons that the market is giving in the bearish market, because this is a fantastic opportunity to learn. And once you are doing things properly, definitely when the next bullish cycle comes, you should be in a prime position to make money and make use of the opportunities as well. So that is what I would like to discuss over here. I would urge you strongly that do not go aggressive in the market, because we never know. If I can just remove all of these drawings tomorrow, no one knows if Nifty 50 will go to this level, or this level. Whatever level is there, if the market is going below this level, focus totally on risk management. Focus totally on risk management, because tomorrow when things will be heading in the higher direction, if you would take care of this aspect now, then only you would be there in the prime position to make money. So right now with defensive position sizing, what you could have done is you could have lost lesser money, and tomorrow when the market turns, you would have used that capital and make use of the correction that has happened in the market. Because usually what happens is that people miss out on the correction, and now when the market is falling, the news is terribly negative. So in the negative market, there is a saying that good prices and good news never come together. So right now we are having good prices. Do look at the opportunities which are there. Do look at the stocks which are setting up. This is a fantastic time to learn, and I would urge you, go and have a look at the market. Keep your eyes open. You would definitely find some very good stocks in the times to come.